The world wakes up to a single choke point, a narrow strip of water just a few dozen miles wide, holding the fate of the global economy in its currents. The Strait of Hormuz, roughly 1/5 of the world's oil, passes through this corridor every single day. Tankers, supertankers, entire floating cities of fuel, all squeezing through a geopolitical pressure valve that has now become the center of a global crisis. And when that valve tightens, the entire planet feels it. In early 2026, tensions explode. Conflict between Iran, the United States, and regional powers turns the strait into a battlefield of uncertainty. Ships hesitate, insurance companies panic, crews refuse to sail. Traffic doesn't just slow, it nearly stops. Oil markets react instantly. Prices surge past $100, then climb higher, eventually touching around $126 per barrel at the peak of the crisis, one of the sharpest spikes in modern history. Wikipedia. This isn't just another fluctuation, this is shock, a systemic shock, and at the center of it stands one figure, Donald Trump. His administration scrambles to respond. Military pressure, naval positioning, economic signaling. Promises are made to keep oil flowing, to reopen the strait, to stabilize markets. But reality doesn't follow statements. Shipping companies aren't convinced. At one point, only a handful of vessels dare to pass through waters that normally see over 100 ships a day. The Guardian. The message from the market is clear. Control the strait, control the global economy, and Iran knows it. Tehran leverages geography like a weapon. Control over the strait becomes leverage not just militarily, but economically, a bargaining chip against sanctions, against pressure, against isolation. Even when the water isn't physically blocked, fear does the job just as effectively. Because in modern markets, perception is reality, and then suddenly a shift, a ceasefire, a signal. Iran announces the strait is open again for commercial traffic. Oil prices don't wait. They drop sharply, more than 10% in a single move as traders react to the possibility of restored flow. Markets rally, stocks climb, energy panic cools. But beneath the surface, nothing is fully resolved. Because open doesn't mean free. Ships are now required to coordinate passage. Routes are restricted. Military vessels are still blocked. And a U.S. naval presence remains in place, creating a tense, controlled corridor rather than a truly open one. This isn't stability, it's managed uncertainty. Meanwhile, hundreds of tankers remain stranded, waiting for clarity, for safety, for guarantees that may never fully come. So where does Canada enter this story? Not through headlines, but through structure. Because while much of the world depends on oil flowing through Hormuz, Canada doesn't. Canadian crude largely moves through North America via pipelines and alternative routes, bypassing the choke point entirely, and that changes everything. When global oil prices spike, Canada benefits from the price increase, without facing the same level of logistical disruption. It's not that Canada bypasses the crisis entirely, but it is less exposed to the physical risk of the strait. In a world scrambling for supply, reliability becomes power, and stable supply becomes profit. This creates a quiet shift in the global energy balance. Buyers begin to look elsewhere, not just to the Middle East, but to North America, to alternative producers, to anyone who can deliver without geopolitical strings attached. The crisis exposes a deeper truth. The global energy system is far more fragile than it appears. One narrow waterway can send shockwaves through inflation, transportation, food prices, manufacturing, everything. Because energy isn't just another commodity, it's the foundation of modern civilization. And when that foundation shakes, everything built on top of it trembles. Back in Washington, Donald Trump frames the reopening of the strait as a success, signaling that Iran has agreed not to weaponize it again. But analysts remain cautious, because agreements in geopolitics are only as strong as the incentives behind them, and those incentives haven't disappeared. Iran still holds geographic leverage, the U.S. still maintains military pressure, the region remains volatile, which means the Strait of Hormuz is no longer just a shipping route. It's a permanent pressure point, a lever that can be pulled again at any time. And the world knows it now. That knowledge changes behavior. Countries begin rethinking supply chains. Energy diversification becomes urgent, not optional. Strategic reserves are reconsidered. Shipping routes are reevaluated. Because the lesson is clear: dependence equals vulnerability. And vulnerability can be exploited. Even when the crisis appears to ease, the psychological impact lingers. Markets remain sensitive. Prices remain reactive. One headline, one incident, one miscalculation, and the entire system could spike again. This is the new normal. Not stability, not chaos, but tension, constant underlying tension. The Strait of Hormuz is open for now. Oil is flowing for now. But the world has seen what happens when it doesn't, and it won't forget. Because in a globalized economy, it only takes one narrow passage to bring everything to a halt. And what follows this moment isn't relief, it's recalibration. Because once a system breaks, even briefly, it never quite goes back to the way it was. Governments don't just look at the Strait of Hormuz as a risk anymore. They treat it as a certainty, not the question of if it will be disrupted again, but when. That shift alone begins to reshape policy rooms from Washington to Beijing. Energy ministers start speaking a different language. Not about efficiency, not even about price, but about resilience. Strategic petroleum reserves, once considered a backup plan, suddenly become frontline defense. Countries that had allowed their reserves to shrink quietly begin refilling them, even at higher prices, accepting short-term cost for long-term security. At the same time, long-forgotten infrastructure projects come back to life. Pipeline proposals that were once stalled by politics or environmental debates are suddenly rebranded as national security priorities. Routes that avoid choke points, whether across continents or through inland corridors, gain urgency. And then there's shipping. Insurance premiums for vessels passing through volatile regions don't just rise, they transform the economics of global trade. Some routes become so expensive to ensure that companies begin to question whether they're viable at all. So alternatives emerge: longer routes, slower routes, more expensive routes, but safer ones. And in a fragile global system, safety begins to outweigh speed. Meanwhile, global powers quietly test each other. Naval patrols increase, not always openly, not always announced, but present. Subtle shows of force, surveillance missions, exercises that send signals without firing a shot. Because control of energy routes has always meant influence, and influence in moments like this becomes everything. China, heavily dependent on imported oil, accelerates its diversification strategy. Investments in overland energy corridors, pipelines stretching across Central Asia, take on new urgency. Maritime vulnerability is no longer an abstract concern, it's a demonstrated weakness. Europe, already navigating a complex energy transition, faces a dilemma: move faster toward renewables and reduce dependence altogether, or secure new fossil fuel partnerships in the interim to avoid exposure. There's no perfect answer, only trade-offs. And then there are emerging economies, the ones hit hardest. For them, a spike to 126 oil isn't just a headline, it's inflation, it's currency pressure, it's food prices rising because transportation costs increase, it's political instability brewing quietly in the background. Because energy shocks don't stay in the energy sector, they ripple outward, into everyday life, into households, into streets, and sometimes into unrest. This is where the crisis becomes more than geopolitical. It becomes human. At the same time, something else begins to shift, something less visible, but just as important. Investor behavior. Capital starts flowing differently. Energy companies with geographically stable production suddenly look more attractive. Projects that were once considered too slow or too expensive gain new life because reliability is now part of the equation. Even renewable energy sees a psychological boost, not just as a climate solution, but as a security solution. Because solar panels and wind farms don't pass through straits, they don't rely on choke points, they don't get blocked by geopolitical tension. That realization doesn't transform the world overnight, but it changes the direction of travel, gradually, quietly, but decisively. Back in the Middle East, the situation remains fragile. The reopening of the strait doesn't erase the underlying tensions, it simply places them on pause. Diplomatic channels stay active, but so do military ones. Every movement is watched, every signal is analyzed, because both sides understand something critical. Escalation is easy, control is not, and so the region enters a phase that feels stable on the surface, but carries constant undercurrents beneath. A single misstep, a misinterpreted maneuver, a miscalculated response could bring everything back to the edge, and everyone knows it. That awareness creates a strange kind of balance, not peace, but deterrence, not trust, but caution. And in that environment, the global economy continues forward, but differently, more guarded, more aware, more sensitive to shocks. Supply chains don't snap back, they stretch into new shapes. Trade patterns shift subtly, then more noticeably over time. Alliances strengthen in some areas and weaken in others, because crises don't just disrupt systems, they reveal them. They expose where the vulnerabilities are and who holds the leverage. The Strait of Hormuz, once just a geographic feature, is now understood as something more, a pressure point, a signal, a reminder that in a world connected by trade, energy, and interdependence, control over a single passage can influence the trajectory of the entire planet. And even when the Ilmiya appear calm again, the memory of disruption lingers, shaping decisions, guiding strategies, and quietly preparing the world for the next moment when that narrow strip of water becomes the center of everything once more. And then comes the phase no one publicly announces, adaptation at the corporate level. Behind closed doors, executives at the world's largest energy firms begin running scenarios that just months earlier would have seemed extreme. Not just temporary disruption, but prolonged closure. Not just volatility, but structural instability. And when those scenarios are modeled, the conclusions are uncomfortable. The modern energy system, for all its scale and sophistication, is still built on a handful of critical arteries. Remove even one, and the strain spreads everywhere, so companies begin to act. Long-term contracts are renegotiated with new clauses, flexibility clauses, rerouting clauses, emergency delivery mechanisms. Buyers are no longer satisfied with the cheapest supplier, they want the most reliable one, and reliability now has a premium. Shipping giants start redesigning their fleets and logistics strategies. Some invest in vessels capable of longer hauls without refueling. Others diversify ports of call, building redundancy into systems that were once optimized purely for efficiency. Efficiency, after all, assumes stability, and stability is no longer guaranteed. At the same time, smaller oil-producing nations see an opportunity. Countries that were once on the margins of global energy markets suddenly find themselves in demand. Their production may be smaller, their infrastructure less developed, but they offer something invaluable in this moment: geographic distance from conflict. That distance translates into bargaining power. Contracts that once favored buyers begin to tilt toward sellers. Pricing structures shift. Negotiations become more complex, more strategic, because in a constrained market, every barrel matters. Meanwhile, technology quietly enters the picture in a more decisive way. Artificial intelligence systems begin analyzing shipping routes in real time, factoring in geopolitical risk alongside weather and cost. Predictive models attempt to anticipate not just storms, but conflicts. Energy trading floors look less like traditional markets and more like command centers, where data streams constantly update probabilities of disruption. Because timing in this environment is everything. Buy too late and prices spike, sell too early and opportunity is lost. And in between those decisions lies billions of dollars. But beyond markets and models, there's a broader shift happening, one that reaches into the psychology of global leadership. Trust begins to erode. Not completely, not openly, but subtly. Alliances are still intact, agreements still signed, but there's a growing awareness that in a moment of crisis, every nation ultimately prioritizes its own survival. That realization changes how agreements are structured. More safeguards, more contingencies, more what-if planning. Because the Hormuz crisis didn't just disrupt oil flows, it disrupted assumptions. Assumptions about predictability, about control, about how far tensions could escalate. And once those assumptions are broken, they're hard to rebuild. Back in financial markets, volatility becomes the new baseline. Investors begin to expect sudden swings, not as anomalies, but as part of the system. Risk models are rewritten. Portfolios are adjusted to withstand shocks that would have once been considered rare. Hedging strategies grow more sophisticated and more expensive, because protection, like energy, now comes at a premium. At the same time, public pressure starts to build in unexpected ways. Consumers, facing fluctuating fuel prices, begin asking deeper questions, not just why prices rise, but why systems are so vulnerable in the first place. Energy independence, once a political slogan, starts to feel like a practical necessity, and that pressure filters upward, into policy, into elections, into long-term national strategies. Because when everyday life is affected, abstract geopolitics becomes personal, and personal issues demand action. In parallel, defense strategies evolve. Navies around the world study the crisis closely, analyzing what worked, what didn't, and what could happen next time. Choke points like the Strait of Hormuz are no longer just monitored, they're actively integrated into future military planning. Control of these Niket becomes synonymous with strategic advantage, not just in war, but in deterrence. And deterrence, in a world this interconnected, becomes one of the most valuable currencies of all. Yet even as all these changes unfold, there's an underlying tension that never fully disappears, a question that lingers in the background. Was this a one-time shock or a preview? Because if a single disruption can trigger this level of global reaction, what happens if multiple Nikat are affected at once? What happens if another choke point somewhere else in the world faces a similar crisis? The system isn't just tested, it's strained. And in that strain lies uncertainty. The kind of uncertainty that doesn't resolve quickly, that doesn't fade with headlines, but stays embedded in decisions, in strategies, in the way the world now thinks about energy, trade, and power. So even as ships resume their journeys, as markets stabilize, as leaders speak of cooperation and progress, there's a quiet understanding beneath it all. The world didn't just experience a disruption, it experienced a warning. And warnings, if taken seriously, don't just pass. They transform, slowly, unevenly, but inevitably, shaping a future where every route is questioned, every dependency examined, and every assumption challenged, all because, for a brief moment in time, one narrow passage reminded the world just how fragile everything really is.